Hey, Adam Gower here, and I received an email from my guest today, Jon Winick, in his regular newsletter that covered the very timely topic of Evergrande and the implications for what that situation might have on both the US economy and commercial real estate. But there is more under the hood to Jon Winick and his company, Clark Street Capital, that you're going to learn about today. Jon specializes in loan sales. Jon assists banks in selling their real estate collateralized loans by finding investors who want to buy them. This is an area that is of particular interest to me because this is an asset class that I have considerable experience in and enjoy working on tremendously. There are some incredible opportunities that individual investors can enjoy buying loans from banks through guys like Jon Winick. And in today's podcast, we are going to discuss exactly what those are in detail. The loan sale business is a fascinating industry, and you're going to learn all about it today. You can find out more about Jon on the podcast page for today's episode at gowercrowd.com. Please be sure to subscribe to the free Gower Crowd newsletter. It's the only media source anywhere that focuses exclusively on the real estate crowdfunding industry for both passive investors and professional real estate veterans. So go ahead and subscribe there at Gower Crowd, and you will have access to everything that you need to know about real estate crowdfunding. All right, now it is my great pleasure to introduce you to Jon Winick, CEO at Clark Street Capital, where you're going to learn more about the impact of situations like Evergrande impacting the US economy and commercial real estate, as well as a deep dive into real estate collateralized loan sales. Here he is. Jon, thanks so much for being on the podcast today. You have an amazing newsletter. I get it all the time. I'm dying to find out why it's called the Ban Report, so you can tell me about that later. But the reason that I called you and asked you on the podcast originally was to discuss Evergrande. So why don't we talk about that topic just to start with, but trying to keep it evergreen so that it's valid at any time. Can you talk about what's going on with Evergrande and if and why we should be concerned in the United States about the real estate market?
Sure.
In the context of how overseas events can impact the US economy.
Sure. Well, thank you, Adam, for having me on this podcast. Always excited to share my thoughts with people in the industry like yourself.
Thank you.
To talk about Evergrande, I think first things first, it's an extraordinary amount of debt. So I think, I'm not even sure what their total debt is. I guess they have to file bankruptcy to know that, but it's, $310 billion. I did some research and my numbers are slightly off, forgive me, but AT&T is the most indebted US corporation and their total debt load is 170 billion. And presumably AT&T has very stable cash flow, so probably could support a higher debt level than a real estate developer could. A 310 billion, if it were a bank in the US, that'd be pretty close to State Street. It would be one of the top 10 largest banks in the US. So it's a very big number. One thing that's unique about the Chinese banking system is there's no separation between the government and the banks. And I think the debt problem over there is Exhibit A on why you want that separation. The Chinese government tends to use the banks as a tool for economic development, which often leads to excessive lending and high risk behavior in the names of job creation and growing the GDP. Not to get cultural, but there does seem to be issues in some of the Asian countries that are cultural with debt. This whole concept of saving face is often means that lenders never really give up on borrowers and they keep extending, and they're not under pressure. And that can often have really bad results. You saw this in Japan in the 90s, where the Japanese banks were just saddled with all this debt. And the end result was, if you don't deal with this problem, it leads to lower growth.
Yeah, stagnation, right, in Japan, 10 lost years during the 90s.
Right. And I think that's, that's sort of what you have here is you have a very loose banking industry, a real estate development company that was, taking on debt at extraordinary levels. Some of the projects, I'm sure, are cash flowing, many are not. And, there is, you think Americans like real estate? The Chinese are even more trustworthy in real estate and has led to some very unique property bubbles really anywhere in the major cities in China.
So to what extent could a failure of Evergrande, and I've actually not heard the name spoken, I only ever read news, so I'm not sure how it's pronounced, but Evergrande. What are the implications of a failure of this company or another company similar in size on the US economy?
It really depends on what type of failure, right? So you take the 2008 financial crisis, and the Lehman Brothers failure would be the worst kind of failure, right? And the Wachovia failure would be like the best kind of failure. Right. So a lot of
make the distinction between them. Why was Lehman bad and Wachovia good?
First off, Lehman Brothers was thrown into bankruptcy court, which is a very chaotic way to resolve. Also, a very expensive way to resolve something. And I think it caused a serious contagion, and really caused a ripple effect. Whereas Wachovia was basically resolved through the FDIC. The depositors didn't lose any money. Wells Fargo assumed the assets, and it was an orderly liquidation. So first things first, all failures are not good, but there's both an orderly failure and a disorderly failure.
Okay.
So the Chinese government is talking tough that they're not going to bail them out. Well, sure. It depends on what you define a bailout. Just because you prevent a systematic, Lehman Brothers type scenario doesn't mean you bailed out Evergrande. I doubt that the Chinese government's going to bail out the stockholders or bondholders, but I suspect they will do some sort of orderly liquidation where they sort of minimize the disruptiveness of a big failure. Could this cause problems? Sure. I guess the other question is this a bad apple, or are there other bad apples out there?
Right.
And, I suspect they're not the only one. I've seen enough evidence that the Chinese government, the way it treats its banks, they have very high levels of NPLs. Nobody seems to resolve anything.
Non-performing loans, just to tell that one guy in the audience that doesn't know what an NPL is. Yeah.
Correct. So, it's so hard to predict because this is such a unique situation. But, short answer, it's not good. The question.
So, if there is underlying chaos in the Chinese real estate market, the economy, how could that impact the US real estate economy?
Sure. Well, I think everything is more and more correlated, pretty much since the collapse of long-term capital. All these things seem to be somewhat correlated. So, okay, let's play this out. Evergrande collapses. The bondholders, the stockholders take huge losses. There's these various real estate projects which are now sort of worth less and chaotic. So, a bunch of consumers and businesses take losses. It could bankrupt their suppliers. So yes, it certainly would, be felt. Now, it certainly could mean that the Chinese real estate market takes a big hit, and people deploy their money, take their money out of China and put it in the US.
Okay.
So there could be a flight to quality aspect of this, which would minimize the damage. But if we're talking $100 billion in losses, that's not just that's felt by a lot of folks. That's not, I mean, not just the Chinese government taking the losses ultimately. They may step in, but you got all those bondholders, all the stockholders. I mean, that's why you have these people showing up at these town, buildings, town centers, and protesting and so on. So yeah, it's a potentially nasty situation.
So talk about contagion briefly, and then I really do want to talk about loan sales. This is my favorite topic.
Sure.
But before we do, explain how contagion works. I mean, you've described the Evergrande situation as being probably isolated to China. At least that's the implications you've made. And the only side effect might be a flight to quality, right? Capital coming into the US to escape that. But when you think about when you started Clark Street Capital in 2008, the subprime crisis and the real estate, the collapse of the banking system essentially, but the real estate market here had worldwide implications. I mean, it rippled across the world. Why do you not see the same potential occurring in reverse, that something fails in China and it affects us directly in the same way?
Well, I guess my short answer is we don't know. It's hard. This is such a unique situation. This isn't a financial institution. So, okay, it certainly would be worse if this was a financial institution. Okay. Banks play a very unique role in the economy. You really think about like what you need for an economy. And it starts and ends with banks. So, if you're going to have a failure, better two AT&Ts fail than one State Street, right? Because their banks ultimately are more important to the economy. So, I mean, keep that in mind. This is unique. This is a very large default, but it's not a financial institution. You asked about what contagion is use Lehman Brothers, right? I mean, Lehman Brothers failed, and then you had all these swap contracts where Lehman was the counterparty. You caused significant paper losses from banks that had invested with Lehman in various capacity, which caused their capital levels to go down. You had securities that were dumped on the market, which hurt CMBS, hurt CMBS. So the question is how much contagion. There will be some. It's just how isolated it is. All
right. So you've talked a lot about banks, and you've casually mentioned an acronym, NPL, right? As though everybody knows what that is. It is my favorite subject by far. So let's segue into what Clark Street Capital does, what you do, your expertise. I'm absolutely fascinated to hear one thing particularly. Founded post 2008. I was just looking on your website. Tell me the story of how you founded Clark Street Capital. What happened in 2008? What were you doing, and how did Clark Street Capital come about?
Great question. So I've been in the business of the secondary market for loans, for pretty much my whole career. I created a group at GE that sold loans. I went to work for a group at Zions that bought loans. And
I bet we talked. I just checked my emails when I was at East West Bank.
Okay.
There was somebody over there at Zions because we had some loans in, we had some partnerships, what are they called? We were co-funded some deals. And I remember talking to somebody over at Zions.
Oh, I'm sure. No, they were a client. Yeah.
I wonder if it was you.
They weren't my client because I had the Midwest, but
okay.
So I've been in that business. It's a great, interesting business. Keep in mind that my experience in the first, decade of my career was I was working for companies that were growing fast. I mean, I was at GE Capital, grow. Zions, who grew our portfolio originations to over $1 trillion a year. So $1 billion a year, sorry, trillion. That's a lot. And I didn't want to be part of a group that was shrinking. Like I kind of saw the writing on the wall in 2008. I saw our production was going to drop significantly, and I'd essentially be a caretaker, and I wasn't really going to enjoy that. And I thought there'd be an opportunity to make money in this market. When I looked at the loan sale industry, I'm kind of still surprised that how little experience our competitors have in actually originating, purchasing loans in their own, experience. I think that many of the people that work at our competitors have never made a loan, have never purchased a loan, have certainly some key industry knowledge, but we felt that there was room for a niche player like Clark Street. It was very tough in the beginning. One of the things that stayed unique with us is we really don't talk about our clients. And part of that, it's worked out quite well because
you're selling clients, you mean? The people
clients don't want people to know they're selling loans.
Isn't that the biggest irony?
Nobody sells loans until they do. Nobody admits they sell loans. You look up loan sale on Wikipedia, and it's like 3 sentences. So it's kind of a very, backwoods of finance. I call it it's a great sideshow, but it's a sideshow, right?
It's a funny thing that you say that. I was at East West from 2008 through to 2007 to 2010 or something, whatever it was anyway, period of time. And I wanted to write a book about my experiences because there was so much fun we had over there, and was categorically denied the opportunity of doing that because they simply, as much fun as I had selling loans, they simply didn't want, it just wasn't a topic that wanted public airing.
Yeah. And so, ironically, my first clients, I wouldn't brag about them anyway. We had probably some of the worst banks ever.
Right.
I had, I remember there were 7 banks that failed in one day, and I think 3 were clients. So, we built our business, by getting the experience of working in emergency rooms where there were no consequences, right? We did a lot of projects where it's like, this thing is done, there's nothing we can do. But we really learned the skill set of how to underwrite, value, price, sell distressed loans. To be honest, before starting Clark Street, I was not a distressed debt expert. I did purchase and turn around a distressed real estate portfolio. So the opportunistic bone was certainly in my body, but that wasn't my world. I used to sell loans at 105. So the distressed debt market was something that I pretty much learned on the fly. And, it took time. There were certainly several years where it probably took 3 or 4 years before I felt that we definitely had made it, and there were, we weren't going back. But it's not easy starting a business during that period, and banks are not so easy to get as clients. So
right.
It certainly wasn't easy. It's one of those things where if I knew how difficult it was going to be, I wouldn't have done it, but I'm glad I did.
Yeah, but it was too much fun as well. I remember having so much fun doing this. But let's just back up for a second. And please give me the 101 overview of what it is you do. Meaning, you go to banks and you ask them, all right, what loans have you initiated or originated? And do you want to get off your book? So just explain that 101 level. What is it that you look at? And why do banks want to get them off their books?
Sure. Well, keep in mind that there's 2 sides to the loan sale business. And the friendly loan sale side, if you will, which is a much bigger part, is the simple business in which originators sell loans for profit. Now, sometimes they do that through a securitization. But for example, the vast majority of residential mortgage originators are in the loan sale business, right? They originate mortgages, they sell them to an agency. Mm-hmm. They might make, 102, 103. Depends on the transaction. But that's a big part of this business. You have
102, 103, just to cut through the jargon, means 103, 102 uh, um,
Of
against
the
par.
unpaid
So
principal balance.
2 or 3% over par. Par is 100%. Yeah.
And the reason for that is, I'll take an example. Like, we sold some loans recently in the, high fives. Well, if a bank went out and made a multifamily loan today, it'd be in the threes somewhere. So to get a 5% coupon is worth a premium, right? Just the same reason why people will pay a premium for bonds. Right. The premium is typically the difference between, you're stripping out the cost to originate. So you're giving someone assets that they can earn income off right away. That's a big part of it. So selling good loans at a premium, everybody does this, banks, non-bank originators, virtually all assets, consumer, commercial, and we play in all those areas. Mm-hmm. And then you have the unfriendly loan sale business, as I like to say. Mm-hmm. And I would define a distressed loan sale. And it's not always the case, because sometimes you do sell a loan for par, in some cases a premium, even if it's a distressed deal. But generally speaking, it's a situation where a bank or a non-bank is selling a loan for less than par, excluding any discount related to coupon. So for example, you might have a loan at 2%, you sell it 97 cents. Well, that's not really a distressed loan sale. It's just that the yield is so low.
Right.
But so basically, the bank is taking a discount. They're typically selling it almost always to a non-bank entity that has a higher cost of capital. It used to be that if you got if you sold to a 10% yield, you did great. Well, now we're seeing investors pay settle for as little as 7%. So the distressed debt market has been, pricing has been very, very good for.
Okay, but hang on a second. So what does that mean exactly? And before we do that, can I just ask you a small favor? Just tilt your camera a little bit so that a bit more of you's in the screen. There you go.
Drifting down a little.
So when you sell something at a 7% net to the buyer, are these typically? So what kind of loans are these? Are these non-performing, underperforming? Are they reperform? Like, what kind of loans are they that people are buying when they buy?
Well, the way you get to as little, 7% is very, very good execution. But if you take a typical bank loan that's a legacy loan that has a 5% coupon, in order for the investor to make their required high single digit to double digit yield, they need a discount to get there. Now, you do have some cases where you'll have a loan that's $1 million and there's $200,000 of default interest. And let's say the property's worth $3 million. So you reasonably expect to get that. And the borrower can't file bankruptcy for whatever reason. The investor may pay par and still get that high single digit to double digit return. But
that's because in that case, they're after the asset.
Not necessarily, because they expect to get the
default payments,
default interest, and that gets them to their yield. Basically, the lower the leverage on the deal, the less likely. Sure, it's a windfall if the borrower hands the keys on a property worth $3 million and you have a loan for $1 million. But that's a windfall, and people don't typically plan for that. What they're expecting is they'll get their balance plus the default interest. So the 5% coupon plus $200,000 default interest. Say it takes them a year, that gets them to a pretty decent return, probably mid-teens or so.
Right. And because they're non-banks, they can negotiate differently than a bank.
Yeah. So, there's things that banks just have to do, which don't add a whole lot of value. Getting appraisals on a regular basis, distressed debt funds. I actually don't know of one that's ever ordered an appraisal unless they have.
Right.
Typically, they get BPOs. As a general rule in the distressed real estate space, the sellers underestimate the collateral and overestimate the guarantor, and the buyers do the opposite. Buyers are more, focused on the collateral and think the guarantor is not going to add that much value. because they don't know the man or woman, right? So it's hard to. So they're more going to put their faith in the underlying collateral.
So these non-friendly loans, what is the motivation for a bank to sell them? These non-performing, underperforming loans.
Sure. Well, I think it's there's a lot of reasons. Let's sort of go through them. One, they can take the capital treatment on defaulted loans is now higher than what it was pre-Dodd-Frank and pre-Basel. So
what does that mean? Just explain that.
The banks have to hold more capital for a defaulted loan, and that ultimately means they have less lending ability. So
right. Plus, if they get to a certain percentage of non-performing loans, they can actually fail.
Correct. I mean, if and that's a combination of realized losses, perceived losses, and in some cases there are runs on deposits from time to time. But but yeah, I mean, sure. I mean, it could be a lot of punishment. The regulatory scrutiny of having high levels of NPLs, the hassle factor. There's the deployment of resources, the reputational issue. It's often falsely stated that that there are reputational issues in selling loans. It's actually quite the opposite. The banks who sell loans have better reputations than those who don't. So
why is that? Explain that.
Well, I mean, I'll give you an example. There was a bank in a small town, decent sized bank, but they had a loan to a doctor, and definitely your stereotypical good doctor, bad business person, assembled probably the most dreadful real estate portfolio I've seen. And it was just really stupid. There was hardly any cash flow. For one thing, he owned like the most expensive house in that town. But he was a prominent heart surgeon. He probably worked on the hearts of half the board of directors. So he was very well known in the community. But the bank sort of realized, well, there's really three things that'll happen here, right? The bank sells the loan and everything works out. Okay. Well, everything works out, everybody's happy. The borrower was able to ultimately exit, sell the property, refinance elsewhere, and make a decent return. So he's grateful. The distressed debt buyer made a decent return, and the bank got out of the deal. The other more likely scenario is it doesn't go well, and the borrower continues to have trouble making the payments, and the borrower defaults. And the now owner of the loan has to file a lawsuit and file a foreclosure suit. Well, would you rather you be the one in that community filing the foreclosure suit, or would you rather Distressed Debt Fund LLC do it? I mean, it's pretty obvious that it's better for somebody else to do the dirty work, if you will,
right,
than the bank in the market.
To pursue your own borrower, the person you actually originally loaned to.
And to be honest, it's not a skill set for banks. I mean, I've certainly talked to banks that had competent workout personnel, but they've retired. They don't really have a skill set in working out assets anymore. So, it's you're better aligning capital and resources with parties that are more skilled in resolving problem loans.
So just define for me, if you would, briefly, the difference between an NPL, non-performing loan, and an underperforming loan from a bank's perspective.
Yeah, I mean, I'll just use the FDIC definition. So the FDIC says, okay, if it's less than 60 days, it's still performing. If it's 60 to 90, it's subperforming. If it's over 90, it's not performing. I mean, 90 days is kind of the industry standard of when something is considered non-performing.
And what's important about that is that a subperforming loan can be made performing, but a non-performing loan can never go back.
Well, it could certainly become reperforming. I mean, I don't want to get into a whole rabbit hole with TDRs and so on, but there's a path of no return when you get to NPL status, right? I mean, it's hard to be a good borrower again with the bank when you've had a 90-day delinquency.
And do you see banks making facilitating loans? Is that something that you guys handle?
When you say facilitating loans, what do you mean?
Loans to buy loans.
Oh, sure. And we've done it on transactions where we have had sellers provide financing, or we've had other groups provide financing for everybody else. But it certainly helps yields. There is a distressed debt buyer that we do some business with that has a major Wall Street bank, and they pretty much fund all their money up front. So it allows them to bid a little higher because they have leverage. But bear in mind, leverage works best when there's some cash flow. So, if you had a portfolio of defaulted land loans, leverage doesn't really add very much.
Right. I lost my thought there, but so let me ask this question. So you go to banks and banks say, yeah, we want to clean our balance sheet. We want to get rid of some NPL. We got some sub-performers. We got some foreclosures. We want to get them off our books. What are and they come to you and you market those for them. What is the typical buyer profile for those lands?
I tend to go with the definition of professional loan buyer. Now, I think the type of entity is probably typically a private equity fund. But they could have other structures, right? They may not have any investor capital. It may just be their own money. It may just be a family office doing it. But these are typically firms that have been doing this, at least today. These are firms that have been buying loan portfolios for, in some cases, decades. They developed an expertise. You then have, so in a normal market, kind of what we saw pre-COVID, and now the market's dominated by what I call professional loan buyers. You then have what I call special situation loan buyers, and those are your large PE funds. So your Oak Trees, and so on, the larger funds. Now, those larger funds have to write bigger checks. So they want to look at pools north of, say, 100 or 200 million. Well, today there's not that many pools that big.
Right.
So the special situation loan buyers tend to show up when there's a crisis, and then they, are active for a couple of years and they kind of disappear.
Do you do primarily portfolios, John, or individual asset sales?
We do both. I mean, our preference is portfolios because
it's bigger numbers, right?
Bigger number. There's less risk spread out by a single asset. There's less risk for you. I mean, if you misfire on a single relationship, it's kind of hard to recover, although that doesn't happen very often. But you really have to be right more often when it's a single asset deal. Whereas it's a portfolio, I'm amazed at how wrong we are in individual assets in, say, a $30 million pool of 30 loans, but how right we are on the overall pool, right? Because you're a little high on this, a little low on that, and you end up in a similar place.
I see.
So.
And do you sell to individual investors as well? Individuals who know that they know this building over here at the corner of Walk and Crosswalk, and they see value in it.
Yeah, on occasion. I mean, it depends on the situation. I mean, if it's a large homogenous pool and the bank wants to sell everything, we're probably not dealing with too many of those men and women. But if it's, let's say it's a $15 million offering, it's 3 assets. Sure, we often have people emerge who own the property next door. We even have the borrower show up from time to time.
Isn't that ironic?
It's always a very tricky situation with no right or wrong way to handle it. It's typically what the client wants to do. But yes, we do sell to, individuals from time to time, and they may not take title as individuals, but basically
they are individuals, right? Yeah, my experience was my job was to sell individual loans individually. And the reason for that was we found that funds typically underwrite significantly lower values than individuals do, especially the guy that owns the building next door. He's going to see value in an asset way beyond somebody who's in another state.
But the funds have cheaper debt, lower cost of capital, lower return expectations in most cases. And, it also depends on what the client wants to do. If the client has 10 $1 million loans, and let's say there's a couple individuals that show up, then we may, there's often a choice between, okay, we can sell the whole pool at this price, or we could sell 50% or 70% at this price. What do you want to do? Because it doesn't always work out that the sum of the parts, the whole may be better than some of the parts, but sometimes you don't really have that option, right? You don't have a buyer for the remaining 3 million at a price that the bank would want to transact at. So you say, look, your choice here is to be happy with not selling the whole pool and get a great price, or sell the whole pool and get a good price. So, it depends on the circumstances. It's obviously very dynamic and depends on the nature of the offering. But a general rule, the more granular the portfolio, meaning the smaller average loan size and relationship size, the more likely it's going to sell to
as a pool. Yeah, bigger loans are going to be more attracted to individuals. So how do you manage borrower confidentiality when you sell, particularly to an investor, but also to a fund?
Sure. Well, for the most part, a few ways. First off, the profile of a distressed debt fund is low profile to begin with. There are many groups that buy hundreds of millions a year in portfolios a year and don't even have a website. So by their very nature, they are low profile. If there were a breach of confidentiality that was attributed to them, it would be disastrous to their business. Word would get around. If it happened with us, they couldn't bid on other deals. So there are reputational reasons why people keep information confidential. We do a vetting process on every buyer that we approve to get access to the sensitive materials. If we don't know them, we do due diligence. We also get guidance from the seller. But everyone signs an NDA. We have the ability to restrict access to files. We have various technology, which I won't get into, which helps facilitate confidentiality. In my practical experience, I really haven't had, I could think of one or two cases where there's been a breach. Sometimes a real estate broker will go out and be sloppy and talk to a borrower. I can think of one or two times it's happened. I've never had it blow up on me though, blow up on us. Look, you get the word out, the more people look at it, certainly that amplifies the chances, but we're pretty careful about it. And we've had almost no instances. We haven't had a situation where the seller rejected doing the deal. I did have a situation which was kind of interesting, but the buyer that the bank wanted to buy the portfolio, like, oh, you really need to make sure he bids on it, actually picked up the phone and called two of the borrowers in the pool and said the banks are selling your loans.
Right.
And that wasn't really our fault because the bank basically told us to work with them.
I see.
So there can be issues that come up, but it's pretty rare.
Biggest challenge that you face at the moment, is it finding loans or finding investors?
Look, the buyers are very important. And I don't mean this in a way. We do a lot to take care of our buyers. We have a better process. We minimize dead deal costs. Our loan sale process is superior. But at the end of the day, they don't exist without sellers. So this is a seller-driven business. If you get a realistic seller, the buyers will show up. And it almost doesn't matter what the asset is. I'm amazed by how challenging some of the assets are and how we still do very well in our execution. Right now, quite frankly, there's an imbalance between sellers and buyers. That's why the yields are so good for sellers. And so
where's the imbalance? Too many buyers, too few sellers?
Correct. And part of that is, this whole COVID squeamishness, which is infecting our whole economy, and I think a very negative way, where it's like, oh, you're absolved of all your responsibilities because of COVID. and I don't think that's very healthy. And that's probably been a reason why. I mean, there is this sort of sense of, well, we don't want to give up on our customers right now. They're having a tough time, etc.
You saw that, look, that's not just COVID, John. I mean, I saw that during the global financial crisis.
I mean, the global financial crisis, the banks were under pressure from the regulators. That was the key distinction.
Well, they were, and that's what tipped them over the edge. But that didn't stop their loan officers wanting to protect the relationships that they had, right? You've got these loan officers that have developed relationships with borrowers who are now defaulting. Right. They want to preserve those relationships. They have friendships, and relationships with them.
Yeah, look, I completely understand, and that's one of the biggest challenges is this borrower is a good guy, and he's never
right.
He's always kept his promises before.
Yeah.
There's really no bank that brings a loan committee where they don't say the borrower is an upstanding citizen. I mean, nobody says, oh, this borrower is kind of a piece of shit, but it's a good loan on a good property. We should do it. Everyone's on the board of something. So, there is a presumption that your borrowers are good people and they're stand-up men and women, but obviously we know that's not always the case.
Got a couple more questions to ask, and then we'll sign off. But do you wake up? It's maybe an unfair question, and it kind of betrays what I do every morning when I look at the news to ask you this question. But do you wake up every morning looking at the news, hoping for another financial crisis?
No. I mean, I think that, there are other factors, right? There's the performing loan sale market, for one thing.
Okay.
A financial crisis is not so good for that. There's your own sort of personal investing, right? Mm. And certainly my portfolio would take a pretty big hit. That would be somewhat unpleasant. I think there's a subtle and classy way to go about doing it. Mm. The opportunistic distressed debt community is an unsung hero in a lot of situations. I mean, talk to any bankruptcy judge and say, how important is stalking horse bidders or vulture bidders? And they'll all say, like, without these people showing up, they want to get paid for it. There'd be nothing for us to do. So, they play a very vital role. And I believe that the process of failure, working that failure out, rejuvenation, is so critical to economic growth. And I think what we've done the past year and a half is we won't let any restaurant fail. Okay. Even though every restaurant that fails is replaced by another restaurant. So I think there are real costs to missing the important cleanup phase of any recession or any problem. And you look back the past year and a half, name a big company that failed. Can't name one, except a few energy companies. But even the companies that went bankrupt, like Hertz, fully recovered, paid all their bondholders back at par. It's just, there are costs to that. And, you hear a lot about AMC because of all the investors who are bidding up their stock. Well, wouldn't AMC be in a better shape if Regal Cinemas, didn't exist anymore? Mm-hmm. Or some of the smaller regional chains, although some of them did probably close. But we are doing something that's never been done before. We're having a severe recession and keeping everyone alive. And I think there are real costs to that. I don't look at taking advantage of an opportunity as being a bad thing. I actually think it's the opposite. I mean, if there were no bottom feeders or distressed investors, it would just stay depressed for a while.
I'm sorry about that. I've got a hound.
Like a dog.
It's working.
I got a dog in my office today, but he doesn't bark.
Mine never does, but he's picked this moment to do that. All right, so I've got 3 final sign-off questions, rapid fire questions. Sure. We'll sign off with those. But before I ask you that, your ban report is fantastic. First of all, why is it called ban? I should know that. And secondly, who writes that? There's a lot of content that you put into that.
Well, BAN stands for Bank Asset Network, which is a brand I wouldn't say we're phasing it out, but we don't use it that much anymore.
Okay.
Initially, we were kind of creating a separate brand for our loan sale platform, and over time, we still use it, but it's been sort of diminished by the strength of the Clark Street brand.
Yeah.
So that's where the band report comes. Who writes it? I do, and it's pretty hard to outsource your own voice. I will on occasion have people contribute, and I always encourage people, if they have articles and they want to contribute, or they go to a conference, they want to give the lay of the land. So we do that. It goes out to 60,000 people in the banking industry, real estate industry, loan purchasing industry. So it's pretty widely read. And it is time consuming, but I'm keeping up with the news and the financial markets and my industry anyway. That to put my thoughts to paper doesn't take that much time. I mean, it probably takes half a day or 4 hours each week. And I also use it to promote things that we're doing. So it's definitely been a win-win. And fortunately, since I started, there's always been something to write about.
Of course.
That seems like it's continuing.
Yeah,
I try to stay out of politics. I try to stay out of things that you've already heard everywhere else. I do talk about certain political things, but
yeah, it's really interesting. I really like it. I'm looking at one of them on the screen right now. All right, let me ask you 3 rapid fire sign-off questions I ask all of my guests. Eventually it'll go into a book or something. We'll figure it out. First, what are the key daily habits that you have that keep you productive and successful?
Key day habits?
Daily habits, yeah. First question.
Yeah, and I know kind of when I get off the rails on these things that things kind of go a little haywire. I try to meditate daily. I try to exercise, 5 times a week. Those are the 2 things that kind of are important to me. And then each day every week I have a series of weekly tasks, and then I do that on a daily basis, and I knock them out as I knock them out. So, and on an annual basis, I look at my goals and see where we're at on a pretty regular basis. So
interesting.
But I also believe in being flexible. I don't believe in being overscheduled. I believe in having a lot to do, but not too many meetings.
Absolutely. Yeah, I'm 100% with you on that. I struggle with that, I must say. Second of last 3 questions. What's been the hardest lesson you've learned in real estate?
Hardest lesson in real estate? Well, I used to quote Tom Barrack more frequently. His challenges with the federal government.
Right.
I don't very much, but I do remember him speaking to a real estate group, and he said, I'll never forget this quote, but he said, NOI is an illusion created by real estate brokers to sell real estate. And that is just so very true. I think that, I always wonder, what percentage of borrowers on non-net lease properties that are easy to do NOI achieve their NOI projections in the first year. When I asked a lot of commercial originators, they're all 5%. So I think, converting what looks good on paper to an attractive investment is difficult. My main experience in real estate investing was owning a student housing portfolio, and I way underestimated the management challenge, failed to have a local partner that was also a significant equity owner. So those are some of the lessons I've learned is it's not so easy to turn your projections into reality. And now what often happens is you exceed your expectation on your disposition price, right? So the investment ends up working out really well. But that doesn't always happen, right?
Last question, Jon. What is the most important thing someone interested in investing in distressed bank debt collateralized by real estate should keep in mind? Somebody wants to buy a distressed loan from you, an individual investor.
Sure.
What should they be keeping in mind?
I think that they have to be prepared for all the possible scenarios. They have to be prepared to maybe own the real estate. And I think there's certain asset classes, like, for example, a church, a nursing home, where you may never want to take possession of the collateral for various reasons. You need to understand your way around the legal process. Okay, this loan goes to default. What's it going to cost me to foreclose? How long is that going to take? Is this in a judicial state? Is it in Texas? Like, how long is that going to take? So I think you have to understand the underlying collateral value and really all the possible outcomes that can come out, and you need to be realistic in those outcomes.
Jon Winick, CEO, Clark Street Capital, thank you for being on my podcast today. Thanks
for having me. It was great. Thanks, Adam.
That was Jon Winick, CEO, Clark Street Capital, talking about Evergrande and in more detail about loan sales from banks. Fascinating topic and one of my favorite asset classes. Be sure to go to gowercrowd.com and sign up for our newsletter. It's the only source of its kind that focuses exclusively on the real estate crowdfunding industry. It's totally free and it covers all the latest news updates and information that you could possibly want on the industry, all there at gowercrowd.com. Thanks for joining me today, Jon Winick, CEO at Clark Street Capital, and thank you for listening. That's all for today. Be well, stay safe, and for now, this is Adam Gower signing off.